Hey, welcome everybody to the 40 Finance channel. Today I'm going to be talking about the QQQJ, and I think the most important thing with this particular ETF is to know exactly what you're buying, because with this new suite of products that Invesco has out there, it's easy to get it confused in terms of which holdings are actually behind these ETFs. And in particular with the QQQJ, it sort of has this intriguing name, right? The Nasdaq Next Gen 100 ETF. So obviously, if you're going to invest solely on titles, you would think that maybe this is something similar to like an ARK fund. But the fact of the matter is, this is really just the next leg of the Nasdaq index. So if you figure the QQQ by itself has the top 100 stocks, the QQQJ is essentially the next 100 stocks. So the top 101st stock all the way through the top 200 stock. That's what we're working with here. It's based on the NASDAQ index, and it's just the next level of market cap companies from 101 down to 200. Now, where some people get confused is versus the QQQM, which is basically the QQQ. Okay, it's a repackaged QQQ. The thing that the M offers is a slightly lower expense ratio of 0.15%, and it's really built for long-term buy and hold investors, okay? So if you're intrigued by the QQQ like me, and you're just the type of person who's going to continually buy small lots of shares for the next, call it 10 years, the QQQM gives you an opportunity to do that and get a slightly lower expense fee. The big difference, however, comes in terms of the options market. So if you ever think that you're going to run options with your QQQM holdings, you're probably better off with the QQQ because the volume of that ETF as well as the options pricing is much more robust. But if you're just kind of putting pennies in the piggy bank, so to speak, and you're just going to hold for a long time, the QQQM is very well suited, and it mimics exactly what the QQQ does at a slightly discounted rate. Now, in terms of holdings, we're still on QQQM here. It's going to be the same representation as QQQ. Okay, so we see the top 10 holdings, Microsoft, Apple, Amazon, all of the big dogs, just like the big brother, QQQ. Now let's compare that, though, to what we get in QQQJ. So again, I'm just going to click on holdings here on Seeking Alpha. It's going to give us the top 10. And you see that you have On Semiconductor, Ulta Beauty, Coca-Cola Euro Pacific, and all these other names down here. The bottom line is this is a completely different set of stocks, and I think that that's what's important. There is absolutely no crossover between the QQQ and the QQQJ. Just by nature of market cap standings, all 100 stocks in the J are different than the 100 stocks in the regular Qs. You're also going to notice with the J that it's not nearly as top heavy with this next leg of stocks, okay? So the top holding right now is On Semiconductor at about 2.44%. You've only got two stocks here that are above 2% if you count Ulta Beauty. And then from there, you're in the ones. And the top 10 holdings collectively equal 19% of the total fund. That is much different than the QQQ. So if we just scroll down here, you got Microsoft, 12.52%, Apple, 12.31%. So these top two stocks combined have a higher weighting in the QQQ than all of the top 10 stocks combined in the J. Now, whether or not that's a good thing is really an investing opinion. Okay, from a safety standpoint, you would say that the diversification and being less top heavy is safer than what they're doing over at the Qs. Now, I tend to be of the opinion that leaders lead, and so you want to be out in front of these big mega cap stocks and when they're in an uptrend. But there's something to be said for the way that the QQQJ is constructed, particularly when you're getting into smaller stocks. Now, with that being said, these aren't necessarily small stocks that are in the J. All right, there's plenty of companies in here that have a market cap over $10 billion. We'll look at that in a second. But what you're going to see in this fund is, let's just say these top 5 or 6 companies have a banner year. That is good news for the ETF. But if you bought this saying, you know, I really like On Semiconductor, Ulta Beauty, and Euro Pacific Coke, if they had banner years due to the rebalancing and some of the holdings limits that they have in here, it's not necessarily going to push this particular ETF up as a whole, particularly if, let's just say, the bottom 50% drag out. All right, to get a broader view of the QQQJ, I put together this stock screener list here on Seeking Alpha, and it basically includes all of the stocks in the top 50% of the fund. And quick shout out, if you're interested in learning more about Seeking Alpha, I got a great deal for you down in the description with my affiliate link. Definitely check that out. But when we look at our market caps here, okay, of the top 50%, and you figure that anything above $10 billion in market cap would be considered a large cap stock. And with that in mind, as we look through the top 50%, everything except for TripAdvisor is over $10 billion. All right, so the QQQJ is not a small cap fund. It's not a mid cap fund. Okay, I would say it leans heavily towards large, and probably the second half of it, even though not all those names are in here, the second half of it is going to be mid caps. So you don't want to jump into this fund thinking that you're getting a collection of small and mid cap stocks that may go up, accelerated growth over the next 5 years. If that's what you're thinking, the QQQJ is probably not the right fit. Now, on the flip side of that argument, you could say, good, these are large cap stocks, most of them anyway, and so you can make a broad assumption that they are more stable in terms of price swings. Now, the one thing you are going to get for sure, similar to the QQQ, is a lot of growth names, technology names, for example, but that's not all of what's in here. So here I just sorted by forward revenue projected growth rate here for 2023. And you can see the top one, at least within the top 50%, is plus 34% projected. And that goes to Alnylam Pharmaceuticals. That's not one that I'm familiar with. But look who's down here in number 2. You have United Airlines, a Mongo database, the Trade Desk. What's this one? Monolithic Power System. So even in that top 5, if you figure pharmaceuticals, aviation, advertising, energy utilities, you would kind of figure in this one, similar to a mistake many people make with the Qs, is that it's all technology. That is not true. And on the bright side, you've got most of your top 50%, as we scroll down here, most of the top 50, take out these bottom 3 here, are projected to grow, at least on the top line, here in 2023. Now, let's take a look at EPS growth. And again, you've got some strong numbers. Not all of these, I do want to call this out. If you stop here on the, let's just say the bottom 10 of the top 50%, you do have negative EPS growth and then no EPS growth, which likely means unprofitable in terms of earnings. Okay, let's talk about performance here, and this is another area where it gets kind of hard with QQQJ because this particular ETF did not exist prior to October of 2020. We all know how the market has been here in this past 3 or 4 years, right? It's been a wild time. So you don't have a long track record to go by. But over this past stretch since October, I guess, of 2020, you've got the S&P plus 52%, and you have the QQQJ minus 7.67%. So early returns on this one have probably underwhelmed, right, to say the least. But it got me to thinking, in general, how have mid-cap growth stocks performed over time? Is there anything to the thought process of mid-cap growth stocks outperforming the S&P 500? And so I went through a couple ETFs and I found one here, the Vanguard Mid-Cap Growth ETF. And I thought I would study that just for a minute to see, how has the performance been for this one. And real quick, if you just look at holdings percentage, it does not as top heavy as the QQQ, very similar to QQQJ. You've got a plethora of holdings led by technology, right? 24% in technology, then it goes industrials, healthcare, discretionary. So there's a lot of similarities, I would say, at least to the perception of QQQJ. Now, the good news about the VOT is it has an extended history. So let's take a look how mid-cap growth stocks have performed in general against the S&P 500. If we go year to date, VOT slightly above the S&P, 6% to 4.8. If we go 1 year, and that of course includes a pretty substantial meltdown that we've seen in the market, you've got minus 17%, S&P is only down 12%. But let's break it out a little bit farther to a 5-year investing horizon. So let's go back pre-COVID and just assume that we held through COVID and did nothing, and we woke up today. Where are we at today? Well, the VOT did not beat the S&P 500 at today's current price. So you had a 49% return versus a 51% return. Now, the one thing you can see here is that when we came out of the COVID crisis and heading into 2022, there was definitely some outperformance, and that's probably, in general, was the case with mid-cap stocks, small-cap stocks especially, attracted a lot of attention, a lot of headlines. So you did see separation, and then as the stock market declined, you lost that lead, so to speak. Now, what is kind of interesting, at least to me, is you lost the gap between S&P 500, but since those two have come closer together, they've kind of sort of been neck and neck here, which is very interesting. And that's hard to tell. Was it the index being reclassified at the start of 2022? I'd have to go back further. Perhaps some of the high flyers from 2021 fell out of the index, fell to below 200 in the QQQ index based on market cap, and that took care of some of the problem. It also probably eliminated a lot of this growth separation we saw here. But standing about flat, particularly if you go back for about a year like we looked at earlier, and then, on the year to date, you're basically even. But I think in my opinion, if I was just going to compare these charts, right, and I was going to take out the COVID boom, which is, likely a once-in-a-lifetime type event, I'm not seeing a lot here that would insinuate that mid-cap growth stocks are a sure thing to outperform the S&P 500. Now, that could still mean it's worth buying QQQJ. I would probably just say keep it as a reasonable percentage of your portfolio. Maybe it's a plus 10%. Maybe it's 15%. Everybody's going to have a different threshold. On the bonus versus QQQ, you are getting 100 different stocks than you would have in the QQQ. So there is some diversification in there, but we really haven't seen historically over the past 5 years that mid-caps are guaranteed in any way to outperform the S&P 500. All right, so that's a quick overview of QQQJ. Also threw in some other tips in there to help you differentiate between the regular Qs, the M, the J, mid-caps, large caps, all kinds of stuff going on. It can be confusing, and I will say as a QQQ investor and general fan of that particular fund, there's not a lot here in J that would get me to change my focus. I would say, maybe you want to add a percentage just to mix things up and have different stocks perhaps than the regular Qs. But overall, from a performance standpoint, I still believe that Apple, Microsoft, Google, etc. Are going to lead the way into the next technological revolution and ultimately in the next era of a bull market for the stock market. So for me, it doesn't really change what I'm doing that this is out there, but it is, of course, important to know what your options are. And anytime Invesco releases something new, I'm always going to be intrigued and at least read about it and give it some consideration. All right, before you go, don't forget to check out that special offer for Seeking Alpha Premium in the description below. I hope everybody's doing well. We'll see you on the next video.